Imagine a trade that deposits consistent daily profits right into your account. It sounds like the perfect setup, but it carries a hidden trap: the risk of sudden, total account annihilation. This chart visualizes the engine behind those profits, the USD JPY carry trade. You borrow Japanese yen at near zero interest rates to invest in US dollars, which pay a much higher rate. Every day, you pocket the difference, known as the swap. But as we look toward 2026, the global landscape is shifting. If the US Federal Reserve begins cutting rates while the Bank of Japan hikes theirs, that profitable gap squeezes shut. While shrinking rates happen slowly, the Bank of Japan has another tool. If they feel the yen is losing value too quickly, they launch direct market interventions, violent, immediate strikes designed to wipe out over-leveraged retail traders. In late 2022, the Japanese Ministry of Finance stepped in, causing the USD JPY to plunge hundreds of pips in a matter of hours. Overexposed traders lost everything before they could even click sell. Success in 2026 hinges on your ability to anticipate, survive, and ultimately capitalize on these sudden central bank shockwaves. The Bank of Japan doesn't publish a strict rulebook for when they intervene, but decades of data show they care far less about the exact price of the yen and focus heavily on the pace and volatility of its decline. A slow grind is tolerated, a rapid spike triggers an alarm. Before capital is spent, the Ministry of Finance starts talking. They escalate from subtle concerns over currency weakness to explicit threats of decisive action. The final warning is the rate check. When the central bank calls commercial banks to ask for the current USD JPY price, they are telling the market they are at their desks with fingers hovering over the trigger. You can see this fear directly on the charts. Look at this candlestick chart showing a strong upward trend and in the major psychological level, like 150. When the price flattens into a tight, nervous consolidation pattern right below that line, it means large institutional buyers are afraid to push any further. When these signals flash, your immediate response must be defensive. Cut your position sizes drastically. If you normally trade 2 lots, drop to 1 or half, strictly limiting your dollar risk per pip. Move your stop losses tightly below recent lows, and if you have the margin, consider buying USD JPY put options. If the intervention hits, the soaring value of your puts acts as an insurance policy. Recognizing these bureaucratic warnings and technical setups is the difference between being a reactive victim and a defensively prepared professional. When the strike finally happens, the chart breaks down. This chart shows a massive, elongated red candle, instantly shattering multiple support levels. Interventions are intentionally timed during illiquid market hours to inflict maximum pain, with a 400 or 500 pip plunge. Your only job in this exact moment is to do absolutely nothing. Trying to blindly buy the dip and catch a falling knife against a central bank with infinite liquidity is a mathematical guarantee you will blow up your account. The real trading opportunities materialize in the hours and days after the dust settles. You just have to ask one question: did the intervention actually work? If you look at this chart and see the price bottom out, followed by a step-like upward trend grinding right back to where it started, it tells us the global demand for the carry trade remains too strong. That is a clear signal to re-enter your long positions at a steep discount. Conversely, if the intervention creates a solid horizontal ceiling and the price rejects every attempt to bounce, the macroeconomic tide has genuinely turned. Sellers are in control, and you should pivot to identifying short entries. A single market intervention rarely reverses a massive macroeconomic trend entirely on its own. Your edge as a trader comes strictly from reading the price action after the fact. There is a broader systemic risk here. The USD JPY isn't trading in a vacuum. Because Japanese borrowing costs are so low, the yen acts as the primary funding currency for the entire global financial system. When the Bank of Japan forces the yen upward, it triggers a chain reaction. Traders are forced to unwind their carry trade simultaneously, crushing other pairs like UR-JPY, and instantly bleeding into global equities as capital scrambles for safety. You could place a perfect technical stop-loss on your USD-JPY trade, but if your entire portfolio is packed with correlated risk assets, that single coordinated unwind will decimate your account anyway. To survive this, look at this split-screen layout showing the average true range on the bottom. As this volatility index spikes upward, professional traders respond by automatically shrinking their position sizes up top, keeping their overall dollar risk completely flat, regardless of market chaos. If you trade heavily leveraged accounts or prop firm capital, take the ultimate defensive step. Close every open position 24 hours before any scheduled Bank of Japan rate decision. The potential for a negative surprise far outweighs one day of swap interest. Navigating the 2026 landscape means discarding the old set-and-forget mentality. You have to treat your carry trades as a dynamically managed, highly correlated portfolio. Executing a playbook this precise requires an institutional-grade environment. Head to FXNX to open an account, where you get zero-delay execution during extreme volatility, raw spreads, and AI agents to monitor these exact intervention setups for you.